Singapore's central bank has tightened its monetary policy for the second time in a row in a move contrary to market expectations. The Monetary Authority of Singapore says core inflation will remain elevated through early 2027 as surging fuel prices continue to drive up costs. The rate of appreciation of the policy band was increased very slightly compared with the move in April. The range in which the currency can move and the level at which it is centred will remain unchanged. MES says that this calibrated adjustment will allow the Singapore dollar to continue strengthening and cap inflationary pressures. That's partly as economic activity was more resilient than anticipated. Investments in artificial intelligence boosted Singapore's tech sector. The construction sector is also expected to grow due to a strong pipeline of public and private projects, while the financial sector is set to expand steadily on the back of healthy credit growth. Core inflation came in at 1.5% on year in the second quarter, up from 1.2% at the start of the year. That's expected to tick higher in July and remain elevated into 2027 as higher fuel costs push up prices of construction materials and capital equipment. Rather adverse weather could also reduce agricultural output, lifting food prices. But even this outlook remains uncertain. MES says that fuel reserves have been drawn down significantly and renewed supply disruption in the Middle East could cause sharp surges in oil prices. Robust investment growth could also keep inflation elevated. Analysts say that today's tightening move is a preemptive step to guard against those risks.
So for households, the stronger Singapore dollar should help cushion the impact of rising imported costs. In essence, it can reduce the Singapore dollar price of imported energy, food, consumer goods, and inputs. But this does not mean actually that prices will necessarily fall. It does mean that prices will rise more slowly than otherwise would.
The Monetary Authority of Singapore expects Singapore's economy to continue growing at a firm pace in the second half of the year, supported by robust AI-related investments. But analysts warn that persistent high energy prices and import price pressures could weaken consumer spending, limiting the boost from the global AI investment boom. Nadira Zaidi has more.
Singapore's technology sector remains a bright spot, with electronics factory output jumping 38% on year between April and May. Strong global demand for AI memory chips and server infrastructure continues to drive growth, with related investments expected to nearly double from last year. The sector outlook is also supported by steady growth among Singapore's major trading partners, which is expected to lift domestic tech activities.
At some point, these chips that are produced in Taiwan eventually gets channeled through to Singapore, either through advanced testing and packaging, or otherwise through re-exporting of Taiwanese chips to other parts of the world. So that's one way that Singapore actually benefits when one of its key trading partners does well.
However, analysts warn that persistently high energy prices resulting from the Middle East conflict could fuel inflation, weigh on global demand, and pose a risk to the outlook.
So on one hand, strong investment in AI and technology is supporting electronics production and trade, which is good for Singapore. On the other hand, energy prices remain high, and that's raising inflation and reducing households' purchasing power. So if many consumers start cutting back globally, the strength in technology investment may not be enough to support broader global demand.
On the revised 12.5% tariffs imposed by the United States, MES says it will only marginally raise the effective tariff rate on Singapore's exports. The impact is expected to be cushioned by export diversification and strong tariff-exempt electronics exports. Against this backdrop, Singapore's economy is expected to continue growing at a firm pace in the second half of this year.
So the next few months should bring continued economic growth led by AI, electronics and construction, but also somewhat high inflation, especially in utilities, food and imported goods. The stronger Singapore dollar will soften impact, although it will not completely prevent prices from rising totally.
Beyond AI tailwinds, the financial sector and travel-related clusters are also expected to expand, supported by a strong pipeline of public sector construction projects and more tourist arrivals from large-scale events in the second half of 2026.
And for more analysis, we are joined by Barnabas Gan, Group Chief Economist of RHB Bank. Now, Barnabas, MAS has tightened policy again. What do you think convinced the central bank that another round of tightening was necessary?
Thank you for having me on the show. I think essentially we have heard it so many times. The move today has been preemptive, and rightly so. I think because of the fact that inflation or inflationary pressures in Singapore is expected to rise in the second half of the year. And I think from what we have seen, core inflation is likely to actually increase to 2% or above. And this essentially means that that another round of tightening as of today is actually necessary to anchor inflation expectations in Singapore.
Now, MAS expects core inflation to pick up from July and stay elevated into early next year. From your point of view, do you see Singapore entering a period where managing inflation is the bigger concern than growth?
I mean, generally, if we look at the numbers at hand, Singapore has done very well in terms of growth, in terms of investments, in terms of exports. And rightly so as well, simply because Singapore is a small and open economy. We are very well positioned to benefit from the current AI rally. And we have seen that, especially in the electronics, non-oil domestic exports and, environment or element has actually lifted Singapore's exports as well as overall growth dynamics. Generally, I think one thing that probably analysts out there will actually agree is that Singapore's inflation pressures are supply related rather than demand. And this is actually largely led by rising oil prices. And of course, in the Middle East. So I think it's a very dynamic relationship between growth and inflation pressures. A very, very good sense that we have right now is that even though growth will likely see some support into the second half of the year, inflation pressures will also continue to be observed as well over the same period of time.
Now, a question on many's minds of many, how worried should households be that higher prices could become more broad-based over the coming months?
Well, I think it is natural to worry about rising costs. I mean, being a Singaporean myself and being part of the household as well, there will be pressures of higher electricity tariffs as well as higher food prices. As I said just now, inflation pressures are supply related. And this essentially means, a few factors at hand. If we are going to see escalating Middle East tensions, then this basically means higher energy prices. And this will actually lift potentially higher fuel prices in Singapore, and this will lift, transport costs. On the other hand as well, I think El Nino is here and it's likely to intensify into the rest of the year and into next year. This also suggests that food prices will also see some uptick from now to end of the year and into early next year. Essentially means that Chinese New Year, Hari Raya, may see some higher prices as well in terms of food. Last but not least, I think in the immediate impact ahead, the higher electricity tariffs that is already on the cards for July onwards will likely also increase the household costs in Singapore itself.
All right, thanks for those insights, Barnabas. We've been speaking to Barnabas Gan, Group Chief Economist of RHB Bank. Thank you.